Starting off with the elephant in the room here, Lobo. Well, there's actually a couple of elephants. It's a big room, okay, this last week. But let's talk about, I guess, the biggest elephant here, the Fed. Um, the Fed hiked interest rates aggressively last week, yet gold, silver, copper, and uranium, they're all up. Why do you think that is? Aren't we supposed to be crashing?
I love that you ask about them instead of the markets, right? The instant response for most people is what about stocks and so on. And interesting that stocks were also up. So there are a couple answers here, and this is not just the elephant in the room. There's a lot of key data points here, but I think we've seen a tidal shift or a pivotal point, maybe more than a tidal shift. Something important just happened. The Fed did raise rates. It was expected. If they had gone harder, I think that would have rocked the boat because there were signs of softening in the economy, and so harder would have been a bit tone deaf. If they had gone softer, I think that would have shocked people even more. That would have been, oh, there's something wrong. The Fed is easing up. So they did what the bond vigilantes let them do, if you will, and the markets were happy with that.
Mm.
But why did the metals go up? Well, you also had the inflation writing still on the wall. You know, the Fed, more than the rate hike, was kind of the guidance without guidance. It kind of took off the guidance, but at the same time, Powell more or less talked about the terminal rate being maybe 3 to 3.5, and we're already close to 2.5. And so it doesn't take many more rate hikes, and it certainly doesn't take 75 or 100 basis point rate hikes to get to that terminal rate. And he's talking about the end of the year. So basically, he's telling the market that the next couple of meetings we'll see smaller rate hikes. And that was what everybody really wanted to hear. Now, that's the broader market. Why did the commodities take off? Well, if I don't know, the market is millions of people, not one guy. I can call him up on the phone and say, "Hey, Mr. Market, why'd you do that?" But my interpretation of it is that they are seeing the persistent high inflation is good for gold and silver, and they are seeing the so-called soft landing.
Mm.
They think the Fed actually has this under control. So this fear of recession that would have been holding your other metals, your industrial metals and uranium back, I think that came off significantly. And why that came off is beyond me. It's insane. Like the guys that completely didn't see that inflation wasn't going to be transitory and wasn't going to be minimal, they got it completely wrong. It's like the doctor who didn't notice that this giant, rash that you have on your head is the Black Plague, and he didn't see it at all. And now he says it's no problem. We can take care of it. And you believe this doctor who didn't even get it in the first place. I just, it
Mm.
is what it is. The mainstream is what it is, I suppose. But I think that's why the Fed's actions, they were expected actions with some sort of unexpected results. And I
Mm.
have to say that the biggest surprise to me, the industrial metals, not so much, was gold and silver, like the monetary metals response. I did not expect that. The Fed is supposedly beating inflation, and so why would you want an inflation hedge?
Mm.
So some part of the market is not buying that. Some part of the market is saying, hey, inflation's still high. And this is before the Eurozone inflation came out high and the other data came out, which we should talk about. Actually, let me segue to that. You can insert a question here if you want, Antonio, but to my mind, it was really interesting what happened with the Fed, but it was in many ways more interesting what happened afterwards, because we got the PCE report, which came in really scorching hot, and that's their preferred measure of inflation. And we got the employment cost numbers, and those came in hot. So that wage price spiral that economists worry about so much, because inflation has nothing to do with printing money. No, it has to do with confidence and workers demanding higher wages and all that stuff. So that coming in hot, not so high that workers are actually catching up inflation. No, their real wages are still going down, but those numbers came in higher than economists expected, and obviously way higher than a year ago. So there are good reasons to fear high inflation, and maybe the Fed changing its course, maybe not being as apparently dovish as they sounded in the meeting, And that didn't shake markets. Like I would have thought that with those numbers coming in that hot, that mainstream investors would have said, okay, the Fed said that they were going to cool off by the end of the year. Great. But now, now we have this new data and it doesn't look like the Fed can cool off by the end of this year. That didn't happen. So I can't tell you why. I don't know why Mr. Market is being so optimistic, but he is. And the big takeaway here is that this, potential for a waterfall event, a crash that might happen in the near term if the Fed spooks markets, I think we've just seen the Fed and the data do pretty much all they can for now to spook markets, and they haven't been spooked. So this means that I'm less worried about a market crash. We don't get another Fed meeting until September. Unless something major blows up in the global stage, I think actually Mr. Market stays in happy mode. And that's really good for our uranium stocks because the uranium stocks have been, beaten up because the broader markets have been going down. So if you got uranium itself, recovering, if we're into for the next two steps forward stage and the broader markets are doing well, then our uranium stocks should do particularly well. That's not surprising to me. The industrial metal is not surprising to me. I'm just tickled pink that for some reason the investors out there are drinking the Kool-Aid on the Fed's going to fix the problem, but somehow concerned enough about high inflation that they're still buying gold and silver. And sorry, one final point. I'm rattling on here, but one final point. I was especially delighted to see silver do so well with gold. It's something you and I have talked about, that for all of its industrial side, and people call me Darth Silver and all that, it still is tracking gold. It still is moving with gold. And to see silver respond, I think it got both. I think it got a tailwind from the industrial and the monetary side. But to see it moving in tandem with gold was confirmation of that thesis. So that encourages me to remain bullish on silver. Okay,
Yeah,
I covered a bunch.
it's true. Yeah, lots to touch upon. As you said, I definitely want to talk about the recession, the inflation in the Eurozone as well. The first thing, though, that you mentioned was that the Fed didn't give any guidance for the future of interest rates. And they pretty much, I guess they went as far as to cancel forward guidance as a whole. Like they don't see a reason to give it anymore. That's what they pretty much said. What does the fact that they'll stop giving that forward guidance tell you on its own? Like, does that worry you? And also, what is your best guess as to what they're going to be doing in September after this summer?
The crystal ball question.
Yeah.
So Jay Powell doesn't call me up to discuss this with me, but I think probably, he listens to the likes of Gunlock and some of the other, heavier hitters out there, and they've gotten a lot of criticism for the forward guidance, which I do think has painted them into boxes repeatedly. Like if they keep saying, oh, here's our range of choices, and really probably they should have done something else. But now that they've given this guidance, if they had gotten more aggressive sooner with inflation, but they had been guiding otherwise, then that would have been a shock. It could have had counterproductive results, because then people say, "Oh my gosh, the Fed, is they're breaking out of their guidance." So I can't prove it, but I suspect. I mean, I can't really think of another reason for it. The guidance has become a problem for them, so they decided, well, let's just not do that anymore. Yeah. But then in his press conference, Powell kind of, there was no dot plot this time. He kept referring to the June dot plot being, the adequate guidance, which makes no sense to me. The data is already backward looking, and June's already that many weeks ago. And we've had already more backward looking data, but that's higher. Like the June dot plot actually seems beyond useless to me. That's ancient history now, as fast as things are moving.
Yeah.
So kind of striking. But then, yeah, in the press conference, Powell says, okay, we're not giving guidance, but here's what I think will be wrapping up the interest rate hikes, which had, do the math. It's very clear. If you're going to top out at maybe 100 basis points more in 2 or 3 meetings, how many basis points can you hike per meeting? Right. So they kind of yanked the guidance, but I think they kind of gave guidance anyway. It was a strange balancing act. What are they going to do in September? The implications of what Powell said are like 50, 25, 25. and then we'll see. But on the only useful answer here, really, I don't know how useful it is, but I think the correct answer is that there's so much that can happen between now and then. Just look at the data that came out within days of Powell's remarks. And if they think that inflation is going to come down on its own, they think base effects and sorting out the supply chains and perhaps the beginning of the actions that they've done themselves will already begin to bring inflation down. What if it doesn't? Right? We've got this inflation print, the PCE one, is a big surprise because gasoline prices have come down, housing has come down, like the real estate market's gone into reverse with higher interest rates. And a lot of the talking heads were thinking that, okay, all right, we're going to see peak inflation, but we haven't, at least not in the US and not in the EU. Have we really seen a headline number turn down yet? They're still hitting new records. And particularly on the housing front, the Fed doesn't actually use housing costs. They use this owner's equivalent rent. And that is, I understand, I'm not an economist and I haven't done the math on this myself, but I understand it's not just backward looking, but it is highly lagging, like a year to a year and a half. So it's taken a huge time for this large component, very large component of US CPI to edge upwards. And by the way, it's in the core. It's not just these volatile food and energy things the Fed can try to ignore. Housing is in the core inflation, and that has finally started really kicking in with what we've seen over the last couple of years. So it could be that the volatile parts, come off, but that the core just keeps charging upwards because of how far behind that is. And if that comes in really hot, increasingly hot before the September meeting, they may be forced to change their tune. But for now, the markets seem to be thinking it's going to be 50, 25, 25, soft landing ahead. Everything's going to be great. Risk on.
Well, I would actually like it to be that way, but I just have a hard time believing that it's gonna be that way because of what's happening, but also because of GDP numbers. That's also something that I wanted to talk about. And I also want to ask you whether you're buying or selling because of that, based on what you told me last week. But before I do that, let me ask you a simple question. Are we in a recession right now?
Yes, I think we are. And by the way, I'm not just going to do this technical recession thing. I think it's hilarious that, for I don't know how many years, for decades, 2 consecutive quarters of GDP is the accepted definition. And okay, the bureaucracy that labels them hasn't done so yet, but who cares? That's the definition that's been accepted by everybody for decades. And now, oh, well, that's just technical. That doesn't really mean we're in recession. You have strong employment, blah, blah, blah. But, you can't dismiss 2 quarters in a row of negative GDP growth. And whatever the reasons are, it's still 2 quarters in a row of negative growth. You can't just dismiss that. I mean, you can't credibly dismiss that. It's really quite striking. And, they wrote off the Q1 one as, oh, that was mostly just the trade deficit. Well, this time it wasn't so much the trade deficit. So that means that it was more structural issues, deeper issues within the economy. I'm not actually sure that that's accurate, but still, the excuse for Q1 being so bad doesn't apply to Q2, which actually makes Q2 more of a wake-up call. But that aside, people keep saying, how can you have a recession with high employment or low unemployment? That's just not possible. Well, actually, it is. People can be working harder and making less money. And they certainly are in real wages. We know that. But they could actually be making less money in nominal wages. They could be, because of the economic troubles, they could be forced to take on 2 jobs or a part-time job, extra job, making more money. So you could see low unemployment, but I'm not sure what the economic term for this, but the low take-home net for the person, the experience in their life, even if their cash flow is the same. But if now I'm working 1.5 or 2 jobs to have the same or maybe even slightly higher cash flow. Okay, let's say my cash flow is up ahead of inflation. I'm ahead of the game. My cash flow this year is up 25%, right? So I'm up 125 over last year, but I'm working a job and a half or even 2. In terms of my work output, I've actually just taken a cut in my quality of life. I'm working harder for less. So, and you aggregate that across an economy, and people keep saying, how can you have a recession if we have strong employment? Well, you can have that. You can have, there are communist governments that put everybody to work, whether they wanted to or not. And that didn't mean they had a great growing economy. So I just think this is I understand, given recent decades of experience, why people are stuck in this thought, but it's a mistake to be stuck in this thought. You can have a recession with high but less productive employment. So I'm just, never mind the technical definition in 2 quarters. I'm looking out the window and I'm looking at the quality of life of people, and I'm looking, talking to the guy at the hamburger stand across the street or whatever. And to my mind, I think there's a credible case for the U.S. actually being in recession now. Reality on the ground, the experience of the person feels recessionary to me, whatever the talking heads on TV say.
So importance is still on Q3 though, because if Q2, if you're saying the market is, let's call it, they are in copium, whatever opium it might be. The market is on whatever it is. This summer is going to go higher. The market is going to go higher, commodities, equities, and whatever. Come time for the Q3 data, though, and the Q3 Fed day, if we have a 50 basis points increase and still negative growth, it's going to get harder to keep denying it, right? And that's so the market might have a summer run and then a tank towards the end of the year. Is that sort of your framework?
Yes, but not just GDP. So yes, I was just joking with my wife. Denial ain't no river in Egypt. This is a big issue for us as investors and speculators, and clearly another quarter of negative GDP would, be very hard even for the cheerleaders for the administration to dismiss that. But that's not the only thing that can rock the boat. If the employment numbers continue softening, or if there's a major change, like we keep hearing about a lot of these tech giants that are tightening up on their hiring now, and other. If there really is a recession, like a real world recession, whatever the numbers say, eventually that should have an impact on employment. And, I'm saying, okay, some people may be working more jobs or extra is one way to look at it, but there can only be so many extra jobs. And if the economy really is shrinking, and, I do think that at some point that has to happen. And we've got a couple more employment reports before the next Fed meeting, and that could shake things up a bit. But you asked also, am I buying? Is maybe, the key takeaway here. And yes, I put out an alert to independent speculator clients that, I've been concerned about this potential market crash. Never say never, it could still happen. These, like if employment numbers come out spooky, like not just, weakening, but like suddenly dramatically lower, and that serves as the wake-up call for Mr. Market, we could see a big scare. But we had Fed increase rates. We had second, technical definition, second GDP print negative. We have high employment costs. We have record inflation again in Europe, and the global economy does matter, right? So all this stuff happened, and Wall Street closed up for the week. So, if investors can take all those body blows and still go like, yeah, let's go risk on, it's all fine, then clearly, the appetite for risk was not as weak as I thought it might be under these circumstances. And therefore, the headwind that was, or the potential, that was a headwind for uranium, but for like the gold and silver stocks or the industrial stocks, it was a potential buying opportunity. I wasn't scared of the recession or scared of the crash. I was like kind of sort of hoping for the crash to create these lower entry points. And I had a shopping list full of stink bids if we got a market crash. And so what I'm telling clients now, and breaking news to the world. So what I'm telling clients now is, yes, I'm no longer waiting for that market crash. I am looking to deploy now. I have a new revised shopping list that I expect to be buying several stocks this coming week.
Okay, well, I think
uranium, by the way, my friend, is at the top of the shopping list. As much as I love gold and silver, the very first things on my shopping list are a couple uranium stocks that got away from me.